Hey everyone, and thanks for jumping back into the cryptoverse. Today, we're going to talk about strategies for investing $1,000 or any amount into crypto. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the sale on the premium list, which you can find a link to in the description below. Let's go ahead and jump in. So, if you're new to crypto, or if you just feel like you've been navigating it without any strategy for however long you've been in it, one useful tool that I think makes a lot of sense is modern portfolio theory. Now, modern portfolio theory has been around for decades. It's been used a lot, for stock, the stock market and that sort of stuff. There's of course, there's criticisms against anything, but I think this is an interesting perspective into the market. So the question is, let's say you want to invest in the market. Where do you put the money? What do you weight it towards? You see all sorts of people saying, hey, rate my portfolio, and people will often give an answer. The problem is that the answer is biased toward whatever that other person has in their own portfolio. Okay, so if you say you have a portfolio of a certain amount of coins and it doesn't match one of the coins that they have, they might say, oh, your portfolio is not that great because you don't have this other random micro cap in it. So what if we just take a look at mainly Bitcoin and Ethereum, and we're also just going to throw Litecoin in there just to show you how some coins are really not worth your time. Again, don't take it up with me, take it up with the data if you are a Litecoin enthusiast. Now, the first thing we're going to do, this is the first chart. What are we plotting? We're plotting the expected return. The expected return, as always, is our historical return. So it's based on historical returns annually. Then you have it versus volatility, or risk, if you will. It's color-coded by the Sharpe ratio. Okay, so expected return versus volatility, color-coded by the Sharpe ratio. This is a combination of portfolios, Bitcoin, Ethereum, and Litecoin. So you're probably looking at this and you're wondering, what the hell is going on? You just have a random chart with a few dots on it. Well, again, this is where the brute force method comes into play, because only analyzing 10 different portfolio weightings of Bitcoin, Ethereum, and Litecoin isn't going to give you anything that insightful. But what you could do is you could run 100 or 1,000 or 10,000 or 100,000. And then you start to see this shape take form. And you look at this and you say, well, what does this mean? What does this mean? Why does it form such an elegant bullet shape? Well, essentially what's going on is there exists a single portfolio out of all the portfolios that you can imagine, portfolio weightings that you can imagine, that based on historical data maximizes your risk-adjusted returns. It's not about your returns. Everyone's always so concerned about your identical return. What people fail to take into account is your risk, right? You have to understand the risk you're taking, because for every micro cap out there that does really well, there's 10 more that went to zero. And it's easy to look at the ones that do really well and say, well, if I had only put a lot of money into that single microcap, I could have made such and such. Well, to some degree, that's survivorship bias, okay? For every one crypto that went up like crazy, there's tons more that were rug pulled by, anonymous developers, or they had an issue in their code. So keep that in mind. It's all about the risk you take. And the nice thing about this analysis is that it's useful for everyone, right? It's useful for everyone. You can use it to understand portfolio weightings that you might be interested in depending on the risk that you are willing to take, okay? Not what your neighbor's willing to take, what I'm willing to take, what some troll on Reddit's willing to take. No, it's on what you're willing to take. The risk that someone in their early 20s would want to take on probably far outweighs the risk that someone in their 60s would want to take on. The younger you are, you can essentially afford to take more risks because you have plenty of time to sort of continue investing and make it back, because again, with investing, the main thing you need is time, right? Time is really what you need. But if you're older and you're looking to retire, you probably don't want to be playing around with a ton of the money that you have saved for retirement, so you don't want to take on nearly as many risks. So where does that leave us? Well, this is a modern portfolio theory. the expected return versus volatility color-coded by the Sharpe ratio, which is in fact your risk-adjusted return. So again, it's what is your return, what is your expected return per unit risk that you're taking on? And what you see is this nice shape. And the yellow dot represents the portfolio that would have maximized, or that does maximize your risk-adjusted returns, okay? So what does this mean? Well, this up here is known as the efficient frontier. What it means is for a given volatility, for every volatility, over here, discretized however you want to discretize it, there exists a single portfolio that maximizes your risk-adjusted returns. Now, the yellow dot is the one that gives you the best bang for your buck, okay? But there are some people that say, you know what? I'm not interested in a 90% annual return. I'm interested in 120% annual return. What does that mean? Can you always expect 90% annually if your portfolio corresponds to this yellow dot? No. It just means that on average, that's what you would expect. And for some people who think that might sound crazy, just go back and look at the math. This is what crypto does, right? Crypto generally goes up like crazy. It corrects, and then it goes up like crazy again. So the expected returns are quite high, but the downside is also quite high. So again, it's within one standard deviation. You would expect your return to be 90% plus or minus, say, 68%. Okay, so it varies based on that. So it's within one standard deviation. So like 68% or whatever. So there's still a 32% chance your portfolio returns do not fall within the 90% plus or minus 68% bounds, which would be quite a range in and of itself. Okay, so like the lower bound on, let's just say it's 90-70, the lower bound on that would be a 20% annual return. The upper bound would be 160% annual return, and so it should fall within 20 to 160% annual return to within one standard deviation, or with like a 68% probability. So then we have to look at this and say, well, what are all these? What are the portfolio weights? All you're showing me so far is just, lots of dots on a chart. How does that help me? Well, first, let's actually talk about the actual method that we're using. Okay, so this is the Sharpe ratio. The RP is your return. RF is the risk minus the risk-free rate, and then sigma P is the standard deviation of the portfolio's excess return. So what you're essentially doing is you're taking the excess return that you would have gotten between the risk and the risk-free rate, and you're taking the standard deviation of that excess return, because you're assuming you could have gotten some return that was essentially theoretically risk-free. Okay. So there's two main approaches you can take to this, and it's Monte Carlo brute force method, or at least there's two main approaches, or quadratic programming. Okay, so the nice thing about Monte Carlo is that you should converge to the correct solution as long as you run a sufficient number of portfolio weights, right? So if you run 10, you're probably not going to find it. If you run 100, probably not. If you keep running more and more, then you're more likely to converge to whatever the optimal portfolio weights are. The challenge is you just really never know. If you were to run 100 more, would you have found a better portfolio weight? So then that's where quadratic programming comes in, where you can just essentially solve for it. Now, there are some nuances with convexity and whatnot. I'm not going to get into that in this video because I imagine most people don't care about it. But there are ways where you can just solve for the portfolio that does maximize your risk-adjusted returns for a portfolio of whatever cryptocurrencies you're interested in. I know some of you are going to be like, well, why don't you run it for these other cryptocurrencies that just launched because they're going crazy? Well, you need a lot of data. Otherwise, if they haven't lived through the full bear market, if they haven't lived through a phase of the cycle where we just go down for a year or something, then you cannot really assume that the data in is going to give you anything useful. As they say, garbage in, garbage out. If you only feed in data for an altcoin that was in a bull market, and then look at data for Bitcoin at a very select moment in time, then you just don't really get great results. You need to go back years and years and years. Also, you can only go back as far as the youngest coin you're analyzing. So if we're doing Bitcoin, Ethereum, and Litecoin, then we can only go as far back as where Litecoin started back in 2015. So where does that bring us now? Well, it brings us to the useful part of the video. The Sharpe ratio, which again is what maximizes your risk-adjusted returns for Bitcoin, Ethereum, and Litecoin. In order to maximize your Sharpe ratio, it will correspond to 65% Bitcoin, 35% Ethereum, and 0.0% Litecoin. Now, again, anytime I make these videos, and I've been making these videos for years, the Litecoin holders like to say, well, this isn't fair. Litecoin goes up, blah blah blah. Yeah, it does. But again, you look at Bitcoin. Look at it right now, right? Look at it right now. Bitcoin is 2x its prior all-time high. Okay, 2x. Ethereum is not quite 2x, right? It's not quite, but it's still doing relatively well. What's Litecoin doing, right? I mean, it's still between $1 to $200. The prior all-time high of Litecoin was like $385. As I said back in 2019 and 2020 and in 2021, the opportunity cost of holding Litecoin is too damn high, right? I expect Litecoin will trend up with the market. I would fully expect it to trend up with the market with time. I would be surprised if it didn't break its prior all-time high again and continue higher. Maybe go to $500, maybe $1,000 if we're lucky. But, I should say if you're lucky. But every dollar you hold in Litecoin is a dollar you don't have in another project. And those projects that you don't have dollars in could be giving you much better returns than Litecoin. Again, this is based on expected return, or this is expected returns based on historical returns. If all of a sudden Litecoin were to go to, $20,000, and of course a lot of people are going to laugh and say, you were wrong. And fine, right? I mean, I could be wrong. But I look at it and say, well, based on Litecoin's historical data, it doesn't really seem to be the best candidate. So the reason I'm including it in this analysis is so that you guys can see how this type of analysis could be useful for excluding certain coins from your portfolio. Figuring out, what? I'd rather have $1 in Ethereum than have it in Litecoin, okay? Because I expect Ethereum to outperform Litecoin. So then you look at this and you say, okay, well, that's what maximizes the Sharpe ratio. And you're going to get an expected return maybe of just over 90% with a volatility of approximately maybe 68% or so. But some of you are like, wow, this seems nice and all. And you also might look at this and say, a lot of people always say, well, Bitcoin should be the max, or the Bitcoin should be the largest holding in your portfolio, which is what I always say. A lot of people don't really agree with that. But again, you sort of see it when the market goes down like it did for the last several months. Obviously, the last week it's gone back up some. But over the last 3 months, most altcoins have bled against Bitcoin by 30 to 60%. So in the bull, when we were super bullish back in January, February, March, and April, and early May, a lot of newcomers were like, well, why would you hold Bitcoin? Bitcoin never does anything, right? I mean, it's went 58K, then 61K, then 64K. No one's going to get out of bed for $3,000 moves, especially if they bought the top. But that's what I told you back then. I'm like, well, wait till the market goes down, and then you're going to wish you had that Bitcoin. Now, the market's gone down, and a lot of altcoins are holding up relatively okay, but their Bitcoin valuations have still bled. You should be valuing your portfolio in its Bitcoin valuation, because by holding altcoins, you're taking on more risk. And if you're not getting a performance that at least matches Bitcoin, then you're basically taking on more risk and you're getting a worse performance. So you want to have a portfolio on the efficient frontier. If you have a portfolio that's on this end, you're basically taking on the same risk that the people up here are taking on, but your expected return is 20% lower. Who wants to be that guy? Who wants to be that person that is taking on more risk, but their expected return is lower than the other people taking on the same amount of risk? Okay, that doesn't really make a whole lot of sense. But what you could say is, well, I want to be on the efficient frontier, but I don't want to be down here. I want to go after an expected return of, say, 100% or something. So what we can do is we can go up volatility. So if you're going to go after a higher expected return, you're going to have more downside risk, and you'll see that. If you go up to a volatility of 70%, which is a little bit higher than the one with the Sharpe ratio, it would correspond to 60-40. 60% Bitcoin, 40% Ethereum. If you continue down 0.75 volatility, you're looking at 48-52. So this is an example where Ethereum would actually be a larger percentage of your portfolio if you want to come up here. You keep going down 80% volatility, you're going to see at 38.62. At 85% volatility, you're looking at 29.71. Whew. 90% volatility, 21.78, 1% Litecoin. So I was surprised to see this, honestly, but at 90% volatility with an annual or expected annual return of 110%, there was 1% Litecoin in there. I don't know. 95%, 1% Litecoin, 13% Bitcoin, 86% Ethereum. 100% volatility, 6% Bitcoin, 94% Ethereum. Litecoin went back to zero. And then let's go up to 103, which is basically the top. 1% Bitcoin, 98% Ethereum, 1% Litecoin. So what you see is that it sort of tells you what you already know. Like if you go heavier in Ethereum, you are hoping you get higher returns. But it's also telling you that you're taking on more risk by doing that. So yes, you can go gamble with altcoins, or maybe don't call it gambling. I mean, first of all, I don't consider Ethereum an altcoin. So I'm saying you can go invest in altcoins that you expect to give you higher returns. But the principle is that you can do that. You're taking on more risk by doing that. So just know that you're taking on more risk. A lot of people bought altcoins at the end of 2017, early 2018. It took years for many of them to get back to their prior all-time highs. And most of those altcoins never even got close to the prior all-time highs. Fortunately, a lot of the ones we covered do, but a lot of them never did. Okay, a lot of them never even came close to their prior all-time highs. So there is an opportunity cost of your money. And that doesn't just go with crypto. For every dollar you put in crypto, you're not putting it somewhere else. For every dollar you put in the stock market, you're not putting it somewhere else. For every dollar that goes into real estate, you're not putting it somewhere else. A lot of people talk about buying houses and buying real estate. Well, again, there's an opportunity cost in the down payment that you're using. Yeah, maybe you're not paying rent, and et cetera, but there's an opportunity cost in the down payment. Like, let's say you put like 30 grand down on a house or something, there's still the opportunity cost on that had you put that 30 grand into the stock market or into crypto. What would that 30 grand have done? I'm not saying you shouldn't own a house, right? I'm not saying you shouldn't own a house. I'm just saying you should consider it as an opportunity cost. It's not all about do you have to pay rent or do you not have to pay rent. It's about what's the opportunity cost on you not paying rent. Not, if you rent, it does give you some flexibility. You can move. You don't have to pay for repairs. You don't have to give a down payment on the house. If you don't get 20%, you don't have to pay PMI. There's a lot of advantages to renting. There's also a lot of advantages to owning your house, right? I mean, you're building equity. You don't have to worry about the landlord kicking you out. You can do whatever you want to the house. You don't have to get anyone's permission. There's some security in just simply owning your own house. Maybe you want to rent out your house and then you could get income. So there's advantages and disadvantages. There's opportunity costs to everything, right? To everything. So we're specifically talking about it with regards to crypto. For every dollar into Litecoin is not a dollar into Ethereum. For every dollar into Ethereum is not a dollar into Bitcoin. Bitcoin's the safer play. Bitcoin will have less downside risk, but it will also give you less upside potential. What this shows is that the risk you would be taking on if you bought Litecoin is probably not worth it, right? I mean, like, honestly, there's a decent, what this shows is there's a decent chance that it's just not worth the risk, right? You'd be better off just putting it into Bitcoin, okay? Remember, it wasn't that long ago that Bitcoin was trading at $3,100. Now it's trading at $40,000. At the same time, Litecoin was at like $20 or so, and now it's gone up some. But Bitcoin has actually been performing really, really well, even against an altcoin, Litecoin. So Bitcoin, we know, at least if we're going to be deterministic about anything, which we probably shouldn't be, but if we are, Bitcoin is going to stick around. We can't say the same thing for any other crypto. If I were to have to say the same thing about another one, I would just say Ethereum. After that, my third one would sure as hell not be Litecoin. So Bitcoin and Ethereum, those two I think are absolute musts in a portfolio. If you're new to crypto, I always think, it's not financial advice. I don't think you should start with anything other than Bitcoin. After you have some Bitcoin, I would personally go to Ethereum. After that, I would explore altcoins. I would not include Litecoin, right? I'm using this to show you why I would not include Litecoin, because there's plenty of other coins that, given the risk you're taking on, would give you a better theoretical return based on historical returns. Hopefully that makes sense, okay? So we've covered modern portfolio theory. We've looked at the efficient frontier. We've looked at the Sharpe ratio. You want to be on the efficient frontier. You want to have a portfolio that has decent weighting of Bitcoin in it, so it protects you against the downside risk when things get bearish, like they have been for the last few months. Obviously, if things go bullish again, you might say, well, you want less Bitcoin. Well, no. Bitcoin can go on a crazy run. Remember what Bitcoin did in October, November, and December, and early January before any other coin did anything, more or less? Don't forget that when Bitcoin goes to 6 figures, you'll want to be there for it. You want to have a position in it. You don't want to miss out on that. I don't know if it's going to happen now, 6 months from now, whenever it happens, you don't want to miss out on it. If you guys like the content, make sure you subscribe to the channel, give the video a thumbs up, and also check out the Telegram channel, which you can find a link to in the description below. Remember, we do have the sale on the premium list. We have no ads here. We have no affiliate links. My words are not paid for. No AdSense, no paid promotions, nothing. If you want to support the channel, check out the premium list. We have a sale on it now. You can find a link to that in the description below. You'll know how I'm navigating these markets. Thank you guys for tuning in. Subscribe. Click the bell icon to turn on notifications. And I will see you next time. Bye.